It's 9 a.m. in Shanghai, Shenzhen, and here in Hong Kong. You're watching the China Show. I'm Annabelle Droulers with David Ingles.
Good morning. We're counting down to the open of markets in Greater China. Our top stories today: stocks across the Asia-Pacific extending record highs after big tech regains momentum. When you look at the Wall Street session, the dollar holding losses and Treasuries steady as traders await U.S. jobs and also inflation reports.
Chinese regulators, meanwhile, advising financial institutions to cut exposure to U.S. debt, citing concerns over concentration risk and volatility.
And Alphabet goes on a bond spree to fund its massive AI spending plans, raising $20 billion from an offering and pitching investors in Switzerland and also in the UK. Good morning. Welcome to the program. We are approaching the Tuesday Open, and the tailwinds are blowing in the direction of bulls today. As you can see, 0.9% to the upside. On the regional benchmark, we are just getting a couple of markets coming online. We'll talk about that in a moment. But yes, risk appetite is back. There's the other big story, of course, we're talking about as it pertains to our reporting that China's asking its banks to, have a look at your balance sheets and have a look at sort of risk management as it pertains to exposure to treasuries.
Yeah, this is an interesting one because they're concerned, I guess, about the volatility and could it be fiscal concerns as well? What direction is the new governor at the Fed going to be taking well? And how does that play into the dynamic? I think, though, really our Bloomberg intelligence team had one of the most interesting takes on this, and they're sort of not downplaying it, but they're just putting it into perspective. Really, Bank of China is most exposed, but how exposed to the institutions generally in China?
In the event we get a massive leg up in yields, right?
Yes.
And what does that mean? Of course, it's sort of mark to market and what you're sitting at as far as your balance sheet is concerned. But you can see when you look at the MOVE index, right, which is a good gauge of the fluctuations in the bond market, it doesn't seem like there's a lot of vol in there. But again, we're moving into a lot of uncertainty with the new Fed chairman and his stance towards balance sheet reduction and what that means really for Treasury exposure, generally speaking. The other big thing to talk about, and this is somewhat related to this big bond spree, right? So bond issuers are looking at a window of opportunity where spreads are tight and rates are not high, and they're tapping the bond markets like there's no tomorrow.
Well, I think, of course, the big story overnight was Alphabet and $20 billion in issuance. A huge amount of demand for this because it's $15 billion more than they were intending. And also investors were lining up for it. And spreads, to your point, is really interesting. Also, the tenors are very interesting because as part of this, not right now, but they're looking at a 100-year tenor. And we haven't seen that going back to the dot-com era. No,
it's a reminder to have your vegetables in case you want to, wait this one to maturity on the 100. So Bell and I were just talking before the show started. We were looking at some big numbers, right? So I was trying to figure out $650 billion US dollars in 2026, four biggest U.S. tech companies. I think some of the figures here, too, I'm just going through the notes because there are too many numbers. Morgan Stanley expects $400 billion this year, up from $165 billion. I think we're looking at a record $2.25 trillion, right? So will there be enough liquidity in this market? And what does it mean for these spreads, right? All that is to say, we're looking at tech today very, very closely, whether that's in the debt markets, capital markets, equity markets. Taiwan is coming online. TSMC is coming out with monthly sales figures today. We're looking at a rally there. Singapore coming online as well, raising its GDP forecast to 2 to 4%. More on that in a moment. Dollar story. Euro yen's interesting. Everyone looks at dollar yen. Euro yen is now close to the Jan 2022 peak, not 2022. Jan 22, 2026 peak. Beyond that, of course, we're back to 1991 levels, which of course predates the euro in some ways. Okay, Pony AI is in focus today. Big move overnight. WeRide is up here. Golden Dragon Index not really joining the overall rally overnight, but yes, we're looking at Pony AI today on the back of the story with Toyota. More on that in a moment. A50 futures are coming online, and we're looking at dollar China and it was just recently we were talking about the 7 handle. We're now closer to 690 handle on this.
Yeah, but a PBOC as well starting to rein in the ascent of the appreciation. It was an interesting move, of course, with that US Treasury story overnight. You did see that knee-jerk reaction in the dollar and that weakness, so it did contribute to the yuan moves as well. But generally in the session today, just looking at what else they're watching, as you said, Pony AI, Alibaba's going to be another one to track just because its AMAP unit has been summoned by regulators, so the concerns there. China bond sale and that issuance to note as well, and some earnings. SMIC is going to be really one to track, just given the memory chip crunch that we're seeing. It could actually end up showing up in the numbers. And also an interesting debut that I'm going to be focusing on, but that's Axera Semi. It's raised around $400 million in this IPO, so on the smaller side out of the semi space in China this year, but still an interesting one, just given they're doing AI chips or inference chips or SoCs. So another one to track as well.
Yep. Okay. Let's get back to the top story. We did see a wobble somewhat in the U.S. Treasury market. I think it was 3 basis points and a long-dated bond. That's come back to normal shortly after. The story is really Bloomberg has learned here that Chinese regulators have been advising their financial institutions to rein in holdings of U.S. Treasury, citing concerns we talked about, this concentration risks and market fall. Let's bring in Minmin Lo, our China correspondent, here to talk us through. Do we know the target scale and timing of this exercise?
We do not know the target scale, but the timing is certainly interesting because it's happening in recent weeks. Potentially could be a tactical move on expectation that Kevin Walsh and his more hawkish stance as he takes over the Fed. But we understand from sources that the Chinese regulators have been quietly and verbally asking some of the top banks to reduce their holdings of U.S. Treasuries or reduce their purchases. And bear in mind, this is not something new, right? China has been gradually reducing their holdings over the past decade or so. And that's why some analysts are saying, don't read too much into this. And we did see the knee-jerk reaction, the yields lifting up in the early morning U.S. session, but later on stabilized after Kevin has had sort of redirected attention back to jobs expectations. But still, it does reflect perhaps concern over market volatility, over concentration risk, especially with the dollar depreciating over the course of the past year, particularly in January after Donald Trump said he was comfortable with a weaker dollar. And then to your point, Belle, the growing fiscal risks, Fed rate cut trajectory as well.
We mentioned Bloomberg Intelligence and their view, but overall, what's the assessment of the impact on Chinese lenders here?
Yeah, so Bloomberg Intelligence pointed out that, if you look at China's total treasury holdings, first of all, that's close to levels we have seen in 2008. And then when you look at the big 4 lenders, their holdings of U.S. dollar bonds is about $370 billion now, which in total is just about 5% of their bond holdings or 1.5% of their total assets. So when it comes to de-risking, the impact probably is going to be insignificant for Chinese banks. But Bloomberg Economics has a very interesting take. Their forecast is that China will continue to reduce its dollar assets to 40% of what it was in 2024 by 2050. And this is reflecting the global shifts in structural shifts in the economy, right? With the U.S. Share of the global GDP declining, with the U.S. role in cross-border transaction also declining for China as well, especially after the tariff war. China's exports to the U.S. have decreased by about 20% on year last year. So perhaps part of that long-term strategy as well to diversify their assets.
All right, great scoop from our team. That was our China correspondent, Minmin Lo there. And let's get to our other top story now, because Google's parent company, Alphabet, of course, going on a global bond spree and raising $20 billion to fuel the unprecedented spending plan behind its AI push. Let's bring in our global tech executive editor, Peter Elstrom, in Hong Kong this week. So great to see you in person. But
good to see you.
Let's talk about the investor reaction to this, because it's kind of surprising. I mean, we had all the big tech earnings and companies were kind of punished over their capex plans. Now Alphabet goes into the debt market and it's having a completely different reaction.
Yeah, you're exactly right. It was just last week when Alphabet came out and they said they were going to spend $185 billion on capex this year. We're Bloomberg, of course. We checked the data. We ran the numbers. It's the largest capex spending that anybody had ever heard in history. It's more money than any company has spent. That that record lasted for 24 hours. Then it was Amazon that came out and said they were going to spend as much as $200 billion on CapEx going forward. But one of the big questions, one of the reasons their shares were punished last week is because investors weren't sure, are they going to be able to get their hands on the money? If they get the money, how are they going to be able to spend it? So this week we got an answer. Alphabet went out into the market. As you said, they were trying to raise $15 billion originally. Demand was so strong that they bumped that up to $20 billion. They're also going to issue bonds in Switzerland and in the UK for the first time. It's in the UK where they're going to have these famous century bonds. They're going to issue bonds that will last for 100 years. This has not been done very much before. We've seen governments do it, some academic institutions, including the University of Oxford. But when it comes to corporate issuance, there's a lot of concerns about this sort of thing. We saw it with Motorola back in the 1990s, and we saw it with JCPenney.
Yeah, and what happened to those companies, I guess? Like, quite a big change, of course, in the stories of both. Right. Speaking of easing concerns over spending, Oracle has also come out and said, software concerns over software spending, that's not too big of an issue.
Right.
Yeah.
So Oracle, of course, its history is in corporate software, helping companies actually run their operations. That's been a great business for them. And that business, corporate software, has been historically very, very stable. It's been a great business. That's why PE companies have gotten into that business in particular. Oracle is now also diversifying into the data center business. They're spending a lot of money on CapEx to support OpenAI in particular right now. So they've been punished on the corporate software side because we've seen some of these new AI models come out with corporate add-ons that are very useful, including this legal add-on from Anthropic last week. Today, there's one in the market that'll help you find insurance that's hitting the insurance brokers in particular. So there are concerns around Oracle because of that. That's why its stock has been down. But it's been rallying recently, partly because this Alphabet bond fundraising seems to signal that investors are on board with this big build-out, at least at this point. They're willing to help the tech companies finance this build-out. Now, all those tech companies are going to compete with each other for the customers in the AI space. We don't know what that demand is going to look like, but at least it looks like Oracle probably has a better chance today than they did yesterday of raising the money they need to be able to go out and do this build-out.
Fantastic. Peter, nice to see you in person.
Always a pleasure.
Fantastic. Peter Eldstrom there, of course, our global tech executive editor, here with us in Hong Kong. Okay, this is very big news. It's one line, could have massive consequences. So remember Indonesia and the MSCI story. So FTSE Russell, and this is all we know, has postponed or is postponing its index review for Indonesia. Again, just a caveat, we do not know why. We're short in the details. We don't want to speculate at this point in time, but something to keep an eye on as we approach the open of Indonesia in the next hour. Watch this very closely, and you see the chart on your screens. The MSCI story explains that last leg down on the rightmost side. I think we're down still about 11-12% from that high.
Yeah, certainly one to watch. And as you said, that market opening at the top of the next hour. So we will, of course, be across that one. But coming up as well, we've got Amundi Investment Institute joining us to discuss market strategy and why they think diversification is the name of the game. And we're also counting down to the open of trade in Shanghai, Shenzhen, Hong Kong. This is the China Show. Futures looking like we'll have a little bit of upside at the open. More ahead.
Right, welcome back. Just more on this breaking news line, which came through about about a minute back now. So FTSE Russell has come out and said it's postponing its index review for Indonesia. It was scheduled for March. The decision now comes following Indonesia's ongoing reforms. That's according to the index compiler. I could just context, right? So separately, but related to this is MSCI, the other index compiler, which effectively originated this refocusing on Indonesia and talked about, hey, there's some issues around free float. You have until May to effectively put these reforms in. And Indonesia's come out and said, you know what, we don't have to wait for May. What they've come out and said.
They wanted to say, well, they said essentially the regulators, they'll be ready by March.
Okay.
Yeah.
And I guess that's what, we need more clarity on that, perhaps, which is why maybe that FTSE Russell is coming through and saying, let's wait for things to settle and then that. But so far, two headlines, postponing the March index review and the decision because of these ongoing reforms. Okay, let's pivot away from Southeast Asia. We'll revisit this when the market opens up later on, and we'll see what markets make of this, if any. Joining us here to talk us through what's been really a great start to the year. We had wobbles about 2 weeks, and there were record highs right now. Asia Pacific 1%. Aidan is with us here on set, Senior Asia Investment Strategist at Amundi Investment Institute. Bull market is back. How are you thinking about risk exposure at this point in time?
Sure, bull market is back, but volatility remains very, very high.
Yeah.
So, if you look at the markets so far in 2026, I think there are 4 themes that are currently impacting the market, some of which are very similar to what we had in 2025. I think last year was very clear. You got tariffs, AI, and fading U.S. exceptionalism, some of which have remained the same, some being replaced, and I think one more uncertainty has been added to the list. So number one is geopolitics. I think the focal point of Trump policies has moved from tariffs to geopolitics. AI remains top of mind for investors, but I think the narratives are changing. No longer are people just talking about the AI bubble, but some people are actually voting with their feet. And that's why we're seeing quite a bit of a correction and shake-up in the technology space. I think fading U.S. exceptionalism is still live and kicking, and the momentum is actually being accelerated by the foreign policy choices by President Trump early part of 2026. And finally, the added theme to the list is really the Fed uncertainty. Last year, we had a Fed uncertainty when we tried to figure out who was going to succeed Jerome Powell. Now we know who that person is, but we don't know to what extent his unorthodox views about the economy and monetary policy are going to land on the ground as actual policy choices of the Federal Reserve. So I think uncertainties, even unknowns, are arousing markets, and I think the volatilities are really reflecting that investors are struggling to discount these unknowns. So I think volatilities, uncertainties are going to be with us for a period to come.
On the topic of the Fed, to your point, the narrative has shifted because last year we were not only just trying to figure out who would be taking Jay Powell's position, but also trying to understand how independent the Fed would be as well. What kind of scenarios are you mapping out now?
So to me, I think it's still the evolution of the economy matters more about the Fed policies than the political pressure and the personnel changes. We have to understand that the Fed makes a decision democratically. There are 12 voting members sitting on the committee, and it requires a simple majority to really realize some of these institutional reforms that Kevin Walsh has been talking about, as well as the interest rate decisions and the monetary policy balance sheet policies as well. So I think really it comes down to how can Kevin Walsh really convince his peers on the committee to be more aligned with his currently unorthodox views about the economy and monetary policy. So there's going to be a lot of convincing work on his part.
Markets deal in probabilities. Probability that rates are higher than lower in the second half of this year when the new Fed chair comes in. On the balance sheet, too, which is interesting, right?
Sure.
They're stepping back, looking at it, right?
I think you got to look at the different part of the curve differently. I think on the front end, market is pricing in 2 rate cuts, and that's exactly what we are looking at for the policy rate decision for this year. So I don't think it's going to be too much of a change. Obviously, there's going to be a lot of volatilities coming from rhetoric changes and, even Trump's, talking could arouse the market. I think at the longer end of the curve, the fiscal concerns remains very pertinent, and we have a curve steepening trade as one of our focal point for asset allocation this year.
You mentioned the changing narrative around AI and concerns about a bubble. What do you make then of Alphabet's debt issuance overnight and just the sheer amount of investor demand?
So insofar as this debate about the AI bubble, we really sort of look at sort of 2 dimensions. On the very macro sort of policy basis, we don't think AI is a bubble. If this thing is truly transformative and revolutionary, there's a lot of spending and investment that we need to do to unlock its potential. If you look at the US, which is the most aggressive country in developing AI capex relative to GDP is is still less than 1%. And if you compare that to other revolutionary technologies that we have seen over the past century, the peak level of a capex to GDP is normally between 2 to 5%. Right now, AI is less than 1%. So I think to unlock AI's revolutionary productivity potential, we still have a long way to go. So as overall transformative technology, we don't think AI is a bubble. But when it comes to the conduit of AI in the capital market, the very narrow, expensive investment case is centered on those 7 stocks. We do think there are signs of a force, and that's why we recommend an investor to take a more selective and diversified approach.
Okay, so selective, where do they refocus their efforts and energy? Let's put it that way.
So there are 2 ways I think you can build a more diversified and selective portfolio around AI. One is that we know the world average portfolio has been very lopsided towards the US AI. But China and the US are actually competing neck to neck in this race for AI supremacy. The context is too close to call, so we've been recommending our clients to build a more balanced approach between China tech and the US tech. The second way to do it is to think about the entire AI ecosystem. If this thing is truly transformative and revolutionary, surely it's not going to impact just those 7 companies.
That's right.
As the technology matures and become more integrated into the economy and society, the whole investment landscape is going to broaden dramatically. So if you think that the infrastructure, the underlying technology layer of AI supply chain is already richly priced, you can look for opportunities at upstream utility, energy, and downstream with applications. So there's plenty of playfield to fish.
Aidan, stay with us because we're going to come back to you at the open of the China markets just in a few moments. But that's Aidan Yao there, Senior Investment Strategist for Asia at Amundi Investment Institute. And just taking a quick look at where we're setting up for the open today, I think it's going to be really interesting to watch just on the tech theme because we've had a number of different analysts initiating coverage of AI stocks, chip stocks in China, plus also, of course, tracking what's happening with the yuan there. You can see the reference rate at the bottom of your screen. But more ahead, this is Bloomberg. We are 4 minutes away from the open this morning and just taking a look at some of the movers. So Pony AI is one we're tracking closely. We saw the move already in ADRs overnight, so this is not really surprising. But essentially, they've started commercial production of a driverless vehicle in partnership with Toyota, and that's going to help them ramp up their fleet essentially by the end of the year. Also taking a look at PopMart rather, because we've got some sales figures for the monsters exceeding
100 million.
Yeah.
100 million in terms of the monster sales. They came out with that last overnight across IPs and product categories north of 400 million units. It is, of course, backward looking, but it just gives you an indication of how far the story has run so far.
Yes, yeah. To be honest, I actually had to look up what the monsters were. I just don't track PopMart. I'm sorry.
Well, all you have to look is the silver volatility chart. That's a monster for you. Anyway, the open is coming up next. There you go. This is the China Show. Welcome back. You're watching the China Show, counting down to the open of markets. A couple of things. The equity market rally is extending into the Asia Pacific. We're also looking at the currency, which is now obviously much closer to the 690 handle than the 7 handle. Apart from that, there's this big credit story around the AI boom, the capex spend, and whether or not that's actually a leading indicator that you can use for going along some of these Korean names, of course, where some of that spending goes, of course, as it pertains to the AI story in the U.S. Is where I was going with that.
Okay.
Yeah.
No, it has been really interesting because actually when we had those CapEx plans announced, there was a lot of concern around the health of that sort of spending. And actually it was a point of weakness for the
equity markets.
Yes, in the equity markets. Of course, it's been a very different story in the credit market, but lots of questions as well. What does that mean for issuance? What does that mean for spreads as well this year? But let's also take a look at the direction of trading so far for mainland China today, because you said around the dollar and what the yuan's doing, because we have seen that that yuan appreciation. Actually, after we had that Bloomberg scoop, we saw some dollar weakness essentially. But what we're hearing from sources is that China is urging banks to curb their US Treasuries exposure. And so off that, we've seen concerns really around concentration risks, market volatility. As we discussed with Min Min, though, I think Bloomberg Intelligence had a very interesting note on it, just looking at who's the most affected from this. And out of the lenders, in aggregate, dollar-denominated bonds make up a fairly small part of their debt holdings, even less of their assets. But Bank of China is the one that is seen as the most exposed out of these names. We can also take a look at how Bank of China is faring so far today. But again, unchanged so far. So maybe that also just tells you the market reaction. Let's take a look, though, at Hong Kong with the start of trade here today as well, because you mentioned Alibaba earlier about their AMAP unit being summoned. So this is its Maps and Local Services unit. There are concerns around how it's managing its partner relationships, emergency situations, over fare cutting as well. But Alibaba are actually managing to post some gains today. It is sort of a tech-led rally in the session across the board, though. Also taking a look, we do have an IPO today. We can just check if we're starting to see pricing on that, which we are. This is Axera here, which is moving higher essentially in its trading debut this morning, but we are just watching it there. You can see there at the bottom of the screen a little bit high, but mainly this is a company that focuses on AI inference SoCs or system on chips, and they have raised around 400 million in their IPO. So you're seeing that trading debut there. One to track. It is a company that sort of positions itself as a tier 2 supplier to the automotive market, so we can stick on that autos theme. Take a look at some of the auto companies in China, because we had an interesting commentary coming out yesterday from the Vice Minister of Commerce saying that they want to essentially improve or boost auto sales in 2026. A mixed reaction there. Still in the auto space, but getting a little bit more futuristic, I guess, because Pony AI has been another story to track, and we're watching that stock really surging at the open here, but also in line with what we had with ADRs, and the story here is that they're teaming up with Toyota, they're ramping up their self-driving vehicle model, and that is expected to boost their overall fleet size by the end of the year. And then lastly as well, just keeping that AI theme in check, because we've got some analysts, essentially. JP Morgan has initiated coverage of Minimax, Z.ai. They're very bullish on these names, and you're seeing that sort of consequential market reaction today. Their price target for Z.ai is 400 Hong Kong dollars a piece. Minimax at 700 Hong Kong dollars a piece. Also watching some other names here. MetaX, Shanghai Beer and Technology. That's more in the semi space as well, but more coverage essentially being instigated.
11.5%. Didn't we see a massive move on that already? I'm just looking at my screen. Yeah, it was 36% to the upside. Yes, and I think, this really underscores this next graphic that's going to come up, right? So markets have been parsing. They've been pulling away from some of the usual platform names into these new AI plays. And that's perhaps why you're getting this underperformance in Chinese markets, right? So this is actually measured from the start of 4Q last year. So we'll talk more about Korea in a moment. But yeah, it's really underperformed compared to the rest of the peers. How do you look at this, right? If you're sitting on a portfolio of mostly Chinese exposure. Still with us is Aidan, Senior Asia Investment Strategist at Amundi Investment Institute. Big winners in Asia, big bright spots. You have Japan, we talked about that. There's Korea. And then there was China past tense, but obviously there's still some value there. But how do you look at that?
So Asia, we like Asia. Early on, we talked about that we like an emerging market, and you cannot like an emerging market without liking Asia, because Asia is such a big part of that. We think that Asia is going to be a beneficiary from the global diversification away from U.S. dollar-denominated assets. Asia should benefit from a structural weakness of U.S. dollar as well. I also look at the granular views across the Asia market, and I think Asia really is at a crossroad of three big thematics. Number one is AI. Take a look at the best performing sectors in mainland China, Hong Kong, Taiwan, Korea, Japan over the past 12 months. Without any exception, they are all AI related. I think Asia plays a very important role in the global AI ecosystem. So if you're worried about valuations of Max 7, I think Asia actually offers a lot of diversification opportunities. Secondly, we talked about this during the break. There's a corporate reform story in many markets. Korea, Japan have benefited from that over the last couple of years. Singapore last year performed pretty well on the back of that corporate reform narrative as well. And in China, in November 2024, policymakers actually initiated a number of regulatory changes to increase the shareholder returns as well. And we know that high dividend paying stocks have performed pretty well in recent years. And the third and the final theme is really improving fundamentals. On the cyclical front, that's really Japan, right? The reflation, and now with a potential greater fiscal push coming through, I think that reflation story is going to continue to benefit the equity market. And longer term, we like India, we like Vietnam, amidst the changing world orders in both economics and geopolitics.
The Japan equity story, I think we were mentioning during the break, is the election makes that even clearer.
That's right.
Korea's been clear because there's a battery story, there's a memory story, and there's a value-up program. The China story is still uncertain to some people, right? So we re-rated from a bear market. There are people increasing their allocations. The earnings story, though, what's your take on that? Are you convinced by these projections you're seeing on EPS? That's the fundamental story you alluded to just now.
Sure. I think there are a lot of skepticism still about China. I think very few people are not talking about China being uninvestable, but if you look at the long-only positioning on China, they're still underweight. And I often get asked by global investors how to reconcile the weak economy and strong equity market. I think really the key to answer that question is to realize that the markets and the economy are actually trading on two very different narratives. The economy is held back by what we call old China, the real estate related supply chains, even though it's a smaller part of a GDP contribution since 2021. But because households majority of wealth are tied up with real estate. If you don't have a clear bottoming of property prices, the shock to balance sheet, to confidence, to actual spending is going to continue to hold back the real economy. But if you look at the market side, it's been completely powered by new China, the so-called new productive force. Whether that's AI, whether that's technology, innovative drugs, new consumption, material, Labubu, right? New consumption stream. And there are a lot of idle liquidities sitting on the sideline. You know, households have about 165 trillion RMB worth of deposit that can be plowed to use in the equity market because the households have a TINA problem. There's no alternative in China outside of equity. And I would also argue that since September 2024, the policy supports for equity market have been a lot more forceful than those for the real economy. So we don't think the Chinese narrative has changed, but clearly we have seen a lot of re-rating. So earnings, to some extent, need to catch up to really justify the continued rally. And that really is the uncertainty we need to monitor in the earning delivery going forward.
Aidan, great to have you with us this morning. That was Aidan Yao there, Senior Investment Strategist for Asia at Amundi Investment Institute. And let's get more on the outlook for Chinese equities now and bring in our Asia equities reporter, Winnie Hsiao, joining us also in Hong Kong today. And Winnie, I was just watching you nodding there as well to what Aidan was saying. So, of course, sort of the biggest story for China equities is that tech rally losing momentum. But what are you hearing about what Aidan just said and the outlook as well?
Yeah, exactly. It is sounding like, you know, that we are seeing that shift in terms of kind of preference within Asia, right? There is that momentum building up in Japan with the election and also South Korea and Taiwan still gaining with the chip momentum. But on the other hand, China's tech stocks losing a bit of steam. We talked about this memory crunch. And actually, yes, we've heard and read some reports about how some of these PC companies are actually considering using more Chinese memory chips, but actually these companies are not really listed in China just yet. So the Chinese equity market not really benefiting from what we're seeing in the memory crunch just yet. But on the other hand, there is that global volatility in tech, and domestically, you don't have too much catalyst, whether it's the development in AI, which we were expecting some kind of DeepSeek new model by Lunar New Year, but that's not happening yet. And also lack of government stimulus and lack of kind of that earnings coming through just yet. That's also weighing on the Chinese tech stocks. So onshore tech down about 6% so far since that January peak, and HS Tech in that bear market. And allocation shifting towards more consumer names, like you just mentioned, because of that expectation for more spending. So retail picking up, restaurants, airlines.
SMIC is reporting today, I'm going somewhere with this, And our folks are talking about how, to your point, right, it's the memory chip shortages that are perhaps the key issue there. Talk a little bit more about how that is impacting the Chinese market.
Yeah, so as I mentioned, kind of because these big names are not really listed, so we don't see that being positively reflected in the Chinese equity market just yet. But because of those reports that we're hearing, that memory crunch can potentially benefit Chinese chip makers, memory stocks, memory chip makers. So if we see these IPOs coming through, that might actually be more positive for these names as well.
Okay. Winnie Hsiao there, of course, our Asia equities reporter. From one chip story to another, and a stunning $1.7 trillion rally in the Kospi. We just showed you a graphic there, 54% just from the start of 4Q last year. Total return has actually not been enough to close this Korea discount, this valuation gap it's had for many years with global peers. For more on the persistent Korea discount story, let's bring in Sang-mi Cha, our Asia equities reporter as well. So what's happening here, Sang-mi?
Yeah, so Korea discount is that perennial markdown of Korean stock valuation, right? And all this ties back to the structure of companies there, because there's a huge number of companies that are family-run, called chaebars in Korea. And so these companies actually have this incentive. For instance, when you're about to pass on your company to your kids, the inheritance tax is measured by its market share. So then, they have the incentive to actually kind of even engineer lower valuation for their shares, right? So they're trying to, there's so many of these reforms that needs to be done to actually really rescue these Korea discount that's inherent in this market. And so by looking at on paper, the book value has increased. It's now at 1.7 times. That's almost on par with China's 1.8 and Japan's 1.9, right? But again, going back to a year ago, it was below 1. So it's definitely narrowed that gap. But again, when looking at the profits, the Kospi members are now about to have double of their earnings growth. That compared to 24% for China or 14% for Japan. If you factor in these profits, it is still called a discount here.
That is nuts.
Yeah. Let's also talk about, because Korea moving away from equity markets, but very big crypto trading population as well. But we know that a certain exchange is being looked into. What exactly has happened?
Yeah, so I was actually on a weekend shift and I wrote the story as well. But basically what happened was just like a clerical error, within a crypto exchange. Instead of inputting 620,000 won, Korean won, the employee wrote 620,000 Bitcoin. And so that resulted in sending 40 billion worth of Bitcoin to its users, in a promotional event that was supposed to give $1 or $2 as a thank you kind of message. So that's actually triggered a massive panic selling. And it's dropped 18% of the Bitcoin within the exchange in that period of time. So now regulators are thinking, is this really just an error, or is this like a one-off thing? Because this is called a ghost Bitcoin right now. And so they're looking into this whole ledger transactions and whether this can really be done, on those exchanges.
Yeah, and we're not just talking about an unknown exchange. We're talking about BitHum here, which, as I understand, is the second largest exchange by trading volume in Korea. So it's actually quite a significant name to have that sort of fat
finger name too. I was about to say. I mean, if you parse the spelling of the name, yes. Not that was on purpose, of course.
Built-in issues. But anyway, all right. I was at Asia equities reporter Sang-mi Cha there, and we're going to have more in the next hour on the strains for semiconductors. We were just discussing there as well that global AI infrastructure accelerating that build-out. We've got Mirae Asset Global Investment joining us with their demand outlook. More ahead. This is Bloomberg. Welcome back. You're watching the China Show this morning, and here are some of the big corporate stories that we're tracking. China's transport regulator has summoned Alibaba's AMAP unit for talks, citing weak oversight of partner ride-hailing platforms, fare cutting and poor handling of emergencies. In a statement, the regulator also called on the company to honour commitments to cut commission fees. AMAP says it will fully comply with the demands, address shortcomings and operate in accordance with the law. Chinese copper buyers are extending their break over the Lunar New Year as near-record prices chill industrial demand for the metal. One Shanghai-based supplier told Bloomberg the price rally has reduced order books for copper rod and pipe producers. Extended shutdowns over the holiday period are likely to put a bigger dent in the market's momentum.
Let's stay on the commodities theme here. So you have the International Council on Mining and Metals saying African countries could be making a mistake if they embrace resource nationalism. The council president also told us Chinese influence could help support the potential growth of Africa's mining industry.
The US and China and Europe as a third player offer really important opportunities for the continent to choose which they want to work with without necessarily that having to be mutually exclusive. So you can work with the US and the EU and China in different ways. And the bargaining position for African governments has arguably never been greater, because now you have a choice of counterparties. Previously, when the US and the EU were not as present on the continent, you really only had China to work with. But now you can play China off the US, off the EU. And we saw from the Germans a very clear statement that said after decades of talking and sending delegations, we're sending engineers and we're sending capital. Now that is what African governments have been wanting for a long time, saying enough talk, show us what you're really willing to do to support the sector. And I would say that today is the most optimistic I've ever felt about African mining.
Where does the leverage sit, though? Is it on some of these bigger economies? Is it on the producers? Is it on the corporates?
Well, the leverage sits underground. Ultimately, the resource base and how rich it is in the continent is our main aspect that we can be using to get the best deals for Africa. Now, that leverage is shared between companies who may hold the rights to minerals or certainly hold the technical expertise, and governments who are the main interlocutors with their counterparties in the United States. Now, and the EU, for example. Now, what we are seeing is a better level of government-to-government collaboration on the continent than we've ever seen before. This year, for the first time, I have seen a maturing of the conversation on beneficiation. Up until now, basically every African government has said, we want everything from mining to refining to smelting to final production in our own boundaries. Finally, people have realized that's not practical. And so we're starting to talk about, well, if mining happens here, can refining happen in a neighboring country, and can final assembly happen in a third country? That's really positive, because that's a much more sustainable way to go than everyone insisting on having all the value chain in their country.
But that still doesn't mean resource nationalism will go away, not just on the continent, but globally. I mean, even in the US, we're seeing President Trump trying to do the same. I mean, where does that fit into this dialogue?
That is the big risk, especially on something like gold, where people are seeing sky-high prices and saying, oh gosh, maybe this asset needs to sit all in government hands and maybe we need to renegotiate contracts. It will be a huge mistake, a huge own goal on the part of countries on the continent if they were to try and use this moment to radically reshape the sector by tearing up contracts, by arbitrary tax demands, by changing the way agreements have been set up, because that will be the signal to international investors that risk is too high and they will put their money elsewhere. So I really would guard against anybody thinking that this is the moment to arbitrarily change. It doesn't mean that you can't have a grown-up discussion about the fairest way to share the profits, but it does mean you've got to be very clear-eyed that the excitement we're seeing around critical minerals today will not automatically translate to dollars in your country unless the environment is conducive for it.
That was the International Mining and Metals Council president speaking to Bloomberg's Jennifer Zabazadjo. And a reminder of our new online feature, that's the Bloomberg Video Hub. Subscribers can explore live streaming, news and interviews all of our Bloomberg TV shows, including the China Show. Probably don't watch this moment, but you've got reporter, analyst, documentaries, a lot more. You can check it out at bloomberg.com/videos. This is Bloomberg. Here are some of the major stories that we're following from around the world this morning. And a White House official says the exact date in April for President Trump to meet with Chinese leader Xi Jinping has not yet been finalised. That's after Politico reported Trump would head to Beijing to meet Xi in the first week of April. The report says the two leaders could potentially meet 4 times this year as their trade truce holds. US Secretary of State Marco Rubio has criticised the 20-year prison sentence for former Hong Kong media mogul Jimmy Lai. Rubio described the court decision as unjust and tragic and called for Hong Kong to grant Lai humanitarian parole. The 78-year-old was convicted of multiple breaches of the city's Beijing-imposed security laws, as well as British colonial-era sedition legislation.
Okay, just to say that the Hong Kong Chief Executive John Lee, the briefing is starting now, number one. Number two is earlier in the hour, China issuing this white paper on Hong Kong safeguarding national security, on that story that Bell just mentioned there. China supports Hong Kong in punishing acts endangering security. That's according to Xinhua News. Indonesia is a market to watch, obviously on the back of the FTSE story and the update postponing that index review in March. That market opens up in a couple of minutes. The other one thing we want to talk about, this massive rally that's taking place across the region. The dollar is substantially weaker from this time in the last hour, coming up on your screens. You do see that massive dip in the Bloomberg dollar index, which is actually consequential when you look at the MSCI Asia Pacific, which is actually also catching a very, very strong bid.
Welcome back to the China Show. Taking a look at how the Hang Seng is faring half an hour into the session. It's really a risk on sentiment today. And I mean, expressing what we had already in Wall Street overnight, we had that massive corporate debt issuance from Alphabet and just the amount of investor demand, I think, soothing some fears, because what we had in the big tech earnings last week was concerns around CapEx, but partly was driving that was also the concerns there wouldn't actually be enough demand. And that sort of side of the equation has been answered overnight as well.
In the bond markets, right?
Yes.
And the appetite and, given where spreads are. But yeah, it's an interesting dynamic, right? That they're being punished for a larger CapEx number, which they were effectively blessed with last year in terms of the market reaction. But that's gone the opposite way. Anyway, that's just to say, of course, it's interesting when you look across the capital structure, which we'll get into in a moment with our next guest. Very quickly, though, there's a rally taking place across these markets. It was a weak dollar. It is even more so as we speak from the last hour. So we're now at a record high on Asia Pacific. Japan continues its massive run. We closed higher, I think, over 3% on the Nikkei. We're tacking on a further 2.5% there. Taiwan getting a massive upgrade from B of A, bumping up growth forecasts from 4.5% to get this 8%. 8% growth. And just to say as well, we're getting the monthly sales numbers coming out of TSMC later today. EM markets are doing well. We talked about Korea. Manila is one of the leading ones across Southeast Asia. As we can see, the dollar is weaker. We now have a 690 handle on dollar China offshore. We're getting close on dollar onshore. On that, dollar is weaker as we speak, and we're also looking at the Indonesian markets coming online, opening a little changed. So in the last hour, we heard from FTSE Russell. They're looking to revisit this March index review. We've just heard via text, I know who texts these days, but via text from the Indonesian Stock Exchange, how they're saying that FTSE supports the action plan being implemented by authorities. We talked on this earlier on. May was the deadline given from the other index compiler, MSCI. Indonesian regulators have said, you know what, we'll look at March. We'll do it earlier. FTSE did not express any concern, this is important, on country classification, right? The risk was a downgrade to frontier markets. That is not the case according to the exchange, based on their conversations with the index compiler FTSE Russell.
Yeah, and I think just to that point around investor concern, I mean, you're not really seeing expressed so far in equities, because you got the benchmark there fairly flat, actually. at the start of trade. Let's also get to the other big story that we had overnight, which we actually haven't mentioned yet, but China urging its banks to curb their treasuries exposure. And this was a big Bloomberg scoop we had yesterday. We did see that dollar reaction overnight as well, because it was that story around dollar weakness. We've seen the yuan stronger off the back. But let's get more on it now, what it means as well for the banks in question, what it means for their books. But bringing in Monica Hsiao, she's founder and CIO at credit asset manager Triada Capital. So let's take a look here. I mean, what impact do you see this having on treasuries, at least in the shorter term, if anything?
So I think what we saw yesterday was in the short term, for a few minutes, it spiked in terms of the yield in Treasury, but then it sort of came back down and came back to mean reversion. I think that the reality is that all of us have been aware that this has been a gradual sort of reduction of China interest in the US Treasury. But I guess a couple points. One is that this guidance that has been made more explicit on something they were already doing is actually only relating to banks, as it has been announced. Obviously, that on the state side, they also have been reducing, but they haven't made it explicit. Second point is that, we did wonder why this timing. And, it's just my personal guess that, it could be that this is, a negotiation tactic as well, because this is a few days after Trump administration sort of implied that they, or at least signaled that they might be selling a lot more arms to Taiwan, like adding another 20 billion to the 11 billion earlier. So it also is, made to be, known ahead of the April meeting. Then I guess the last point being that, maybe this is also a signal from China, basically, saying to the world, look, I think that we need to consider what should be, the range of safe haven instruments that we should look into from now because of various reasons. But one of them being that I think central banks will look at the risks of unilateral sanction or expropriation. And so maybe it is fitting for everyone to consider sort of something like gold or other sovereign bonds over U.S. And I think that China does want to present some kind of a challenge to the dollar as, it will continue, I think, to be a reserve currency, but at least chip away at that percentage.
How much of it is, I'm curious, just a simple risk management exercise, right? Say it another way, a call on possibly higher yields, which obviously would hit the balance sheet of banks in that event around the Fed conversation, of course.
It's interesting because one of the points cited is volatility and concentration. Now, the concentration risk, they could actually be as concerned about CGB. So right. I think that this, I would say that most people would think it's at least tinged with the political ramifications.
Okay. Talk to us about JGBs, because that's also another issue here. And does that have anything to do with what we're talking about? Why do you think we need to be watching the JGB market very closely?
So for us, JGB, I think, is one of the most topical themes for me this year in terms of potential sort of tail risk, contagion risk, correlation with the rest of the world assets. As we've seen in a few bouts now, when you have had spikes in the JGB, you do see some risk-off correlation with all the risk assets, including stuff like Bitcoin and AI-related assets, as well as earlier when JGB suddenly spiked 40 bips, and especially in the 20-year, it did pull credit spreads. So I think that JGB is important in terms of also as a carry trade and that potential unwind. Plus, the fact that at one point you're going to look at the relative value. We're not entirely there, but I think we're going to get to the point where you're looking at the relative net rate versus, the U.S. net rate. And the question will be, are the domestics, and at what point the domestics will, reallocate away from dollar assets into the domestic.
Net rate, meaning real rates?
real rates.
Real rates, okay. And we're quite far from that, though.
We're far at the moment because we're looking at real, but yeah.
That's right. Okay. Just to clarify that.
What then do you think for Treasuries? I mean, do you change the outlook at all just based on Kevin Warsh's, expected appointment, I guess you could say now?
It's interesting because I was at a, sort of a roundtable event last night, and one of the points that we were discussing is that it's not a zero probability that Trump could surprise everybody again and appoint somebody else. So I think that there's a lot of sort of question marks around this, but, Kevin Warsh, first of all, we don't really know what his positioning might be because we do consider him more of a political animal. And secondly, to the extent he sounded a little bit more hawkish about reduction of balance sheet, Bessent has already come out to comment that this would take, probably up to a year. So I think all of these take time. The most topical around Kevin Warsh is that, he's talked about the balance sheet, but B is actually potential coordination between Treasury and Fed. And then that would then again bring back question marks about independence.
Tying back to the Treasury market, to your point, right, where you look at credit spreads and they're at, I don't know, it depends on where you look, 2007 lows on IG, for example. And there's really this window when you look at the AI spend and how they're going to fund that. There's a window to be had right now to just tap the markets. Why aren't spreads not blowing out? Why aren't they widening given all the supply that's coming? And how are you thinking about this from a credit perspective, in your world, of course?
So, credit spreads is actually overall in IG been relatively tame, although still in the tight end. Yeah. But I would say that first, the guys who've come out to do massive scale, Meta, Oracle, Google, these are still guys who are issuing from the position of bargaining power because they still have net cash. So you're still talking about, companies where people can feel relatively, safe. And you can argue about relative value, but they can come out to do massive issuances. And as you pointed out, Google last night was still multiple times oversubscribed. That said, most of these guys, straight out of the gate, it's not like they are performing. Google came out and, was -1 bip. It's not like a huge win. So I think that the other point I would make is that AI related in the indices is still, sort of single-digit representation. So there's still room for, the real monies of the world to take these and diversify in their pot.
Okay. Do you worry at all about any sort of AI valuation correction, though, and then that ripple effect it could have? Because even right now, it's low, that sort of concentration, but it is expected to maybe make up to say 20% of the overall corporate IG space.
Yeah, as with everything, it's supply and demand, and at some point, this is going to be less rare. For example, I think we've seen that impact, for example, in Asia, because SoftBank has, really been underperforming across the curve and has, struggled to kind of come back even on risk-on days, back to, at least it's struggled to go back to the highs. And so I think we are seeing some of that because SoftBank had issued like so much. So I think eventually we're going to get there, like with everything. We're just not entirely there yet. And I think it's smart of these hyperscalers to front load right now.
What about more in the, I guess, exotic strategies we've seen as well in credit markets? What are you seeing there?
Well, so I think when, we're on the topic of AI-related software, these type of names, while in the investment grade world, in the public bond space, we're not seeing like a huge contagion impact of widening yet, and books are oversubscribed. We're seeing a different picture in the other part of the capital structure, which is levered loans. And in leveraged loans, up to about 16% of that universe is this type of related debt, and these are averaging more like single Bs, and they're highly levered. And then there are a lot more question marks, which you are seeing that expressed through the market widening there. So on the leverage loan side, it's a struggle to find a footing.
So if that's not the place to be, what's the overall advice for credit strategy?
So, for us, I think that we are always keeping one eye on the JGB, as I said, for contagion impact. But overall, we are still cautious on the longer dated on duration. We're more cautious. We're still happy to take carry in the shorter dated high yield side. And I think in investment grade, we're happy to trade the range. I think credit spreads right now, every bout of widening, we see some kind of a rebound alongside, general sentiment. So that's still relatively healthy. We don't have in credit markets any real sign of a liquidity crunch yet. So if anything, it's really the liquidity availability that's keeping all of this still going. Dollar bearishness, to be honest, it actually helps generally EM markets. So it's not a bad thing for EM credit.
Monica, I think we covered the entire capital structure.
We did.
Yeah, even into up the curve and back. Monica, thank you so much. Monica Hsiao, fantastic there, founder and CIO at Triada Capital. Coming up here on the China Show, speaking of AI, I think it's still a topic of conversation we'll get into. Demand is surging. Supply chain and geopolitical pressures are tightening the squeeze on semis, and of course, Mirae Asset runs an actively managed ETF around global AI supply chain. More on that in a moment with Edwin Chan at those times on your screens. This is the China Show.
The election is the internal affair of Japan, but this election reflected some deep-seated and structural issues as well as certain emerging views, trends, and developments, which deserve serious examination by people with insights in Japan and the international community. The lessons of history are still fresh in memory and should not be left behind. We urge those running the Japanese government to take seriously, rather than brush aside, the concerns of the international community.
That was the Chinese Foreign Ministry reacting to the election victory in Japan that we were talking about yesterday. We're still feeling that in markets, in fact, when you look at equity markets in Japan. So now Takaichi's landslide election victory, the result may present, of course, Chinese President Xi Jinping with a dilemma, whether or not to engage with one of Washington's top allies in Asia, as tensions simmer, of course, over those comments a few months back on Taiwan. Right, let's talk about this and really how this impacts relations and the outlook moving forward. Joining us here on set, Nectar Gon, our China economics and government reporter, is with us. So tell us more about, Nectar, that response we just heard to that election victory. What stood out to you?
All right, David. So far, we've seen Chinese officials showing very little sign of budging, right? Just now, we saw the video from yesterday's foreign ministry presser where a spokesperson actually said that China's policy towards Japan is not going to be changed because of one single election. And, the spokesperson also renewed the call for Takaichi to retract her comments over Taiwan and warned Japan against returning to a path of, militarism. Because there has been a lot of concern among Chinese analysts that, with this historic win, Takaichi can be further emboldened. And with a 2/3 majority in the parliament, she could potentially, push forward the reform of Japan's pacifist constitution, which was imposed by the U.S. after World War II. So there's a lot of concern there. But at the same time, we're also seeing a lot of influential Chinese analysts sort of pointing to this potential shift of geopolitical alignment here. Because over the past weeks, we've seen a lot of Western leaders, visiting Beijing, trying to mend ties to hedge against the U.S. So the analysts were pointing out that, Japan would be kind of isolated if it determined to continue to worsen relations with China when, the rest of the world, especially a lot of close U.S. allies, are trying to mend ties with Beijing.
So it's a strong stance then that Beijing's taking, but why have they adopted it, and also why have they maintained it then?
Right, that's a great question, Annabelle, because, we know that China's relations with Japan have been rocky, for over the years. But this time is different because China wants to draw a red line here over the Taiwan issue, which is, for Beijing, the reddest of all red lines out there. And, China has been worried about Takaichi even before she came to office because she was friendly to Taiwan. She's been there. She's been talking to Taiwanese politicians. And the fact that she made these comments so early in his tenure is really concerning Beijing. So Beijing wants to sort of draw the line right there. But more importantly, it's also a warning to other countries in the region and around the world that they shouldn't do anything or say anything that Beijing finds unacceptable over Taiwan.
So how might this play out in the coming weeks and months then?
That's a really open question, David. I think, for now, Beijing is really demanding, for months, Beijing has been demanding that, Takaichi has to withdraw her comments over Taiwan, and that's just politically impossible for her in Japan. So, they're really at a stalemate here. But at the same time, this year, there are opportunities for both sides to come together to re-engage if they wish to. For example, we have the big APEC summit coming up in November, which will happen in Shenzhen. And before that, there will be a lot of meetings, the ministers' meetings from finance to trade to foreign ministry, So there are a lot of opportunities if the two sides decide to re-engage.
Yeah, I guess just wait and see what happens at those lower level meetings then over the coming months.
Exactly.
Great, Nectar, to have you with us this morning. That was our economy and government reporter, Nectar Gan there. And just a quick look at markets as we head into break this morning. But it is really gains across the board that we're seeing here. So the broader index up 1.2%. Lots of optimism translating from the Wall Street session. More ahead. This is Bloomberg.
Right, welcome back. So this low rates environment is showing up in China, is showing up in interesting ways here. So this interbank borrowing spree, right? Check out the daily volume of contracts, overnight repo contracts, rising, this is as of Friday here, record 8.2 trillion. That's renminbi. So quite a bit of activity taking place because of the macro conditions. Iris Ouyang, our FX and rates reporter, is here with us to talk us through this. What is suddenly driving the spike in borrowing in the repo market, Iris?
Thank you for having me, David and Annabelle. So because China already has this low rate environment and the borrowing cost has been very cheap, especially for financial institutions. And recently, the PBOC has injected various liquidity via various liquidity tools, such as the bond buying and outright reverse repos, as well as MLF. So the markets are expecting even more easing after the holiday. And that's driving the rates lower. And there is also room for arbitrage and the leverage bond buying. For example, if a bond trader are borrowing via this overnight repos and they buy the 10-year bonds, that will give them around 50 BPs in return.
You mentioned Lunar New Year, and of course that's really fast approaching. What does it mean for liquidity conditions overall then?
Yeah, the Lunar New Year usually it's a period where people will see the stress in cash conditions. Yeah. And the PBOC has been doing a lot recently, such as we use the 14-day reverse repos, as well as I mentioned, the outright reverse repos as well. So basically, the authorities' signal is very clear that they want to keep the liquidity abundant, especially when China is still having a sluggish demand and a sluggish property market as well. The PBOC has vowed to support the economy, this kind of like a top-down mandate that they need to do. So the markets are expecting there could be rate cuts or triple cuts after the holiday. The market's expectation for the funding costs is that they will remain at low level, but it's hard for the overnight repo rate to go further below the current around 1.20%.
And how has the overall, just the market, the liquidity conditions, how has that showed up in these, how has it impacted markets?
In summary, the rich liquidity is helping the bond markets, especially in recent days. We are seeing the 10-year yield drop to below 1.8%. That was the lowest since November. And traders are having quite some discussion since yesterday on this rate because, the bond yields have been range bound and they are waiting waiting for more catalysts to go into the bond market, especially, when China will resort to more fiscal stimulus this year. So I heard this morning that traders are discussing there could be more bond boosts coming back to the markets.
Oh.
So it's possible that China is going to have a bond and equity boost this year.
Okay, fireworks into the new year, right? There we go. Next week. Iris, thank you. Fantastic. Iris Oyan, our FX and rates reporter.
Yeah, let's also take a look at some of the moves in the session because these are, we're seeing some kind of mixed moves here, but some downward pressure actually on some of the insurance broker stocks that are listed in Sydney this morning. It's actually quite an interesting story because last week we had all of that concern around the Anthropic moves and what that meant for the software industry, legal software firms. Today we've got a different story that's in focus here, but it's more AI disruption fears essentially because there's a shopping platform in the US called Insurify. They've just launched a new tool that uses ChatGPT to compare auto insurance rates using a few different vehicles. We saw those stocks really pummeled in the US. As I said, it's translating to some of the Aussie names in the session, but also taking a look at SoftBank shares today because we had SoftBank Corp reporting their figures. We saw the underlying operating profit beating the brokerage forecast from SMBC Nikko, but essentially we actually saw generally in line with expectations those figures. The stock, though, is surging today. It's 11:29 a.m. in Tokyo this morning. Japanese markets are just about to go into their lunch break, but they're going in on a high note, essentially, because lots of gains there. You can see the Nikkei 2.8% to the upside.
Yeah, and I think we were up over 3% yesterday. I think Aidan Hsiao, who joined us in the last hour, talked about how the equity market after the elections is the cleanest way to play the Japan optimism story. And it's very, very clear to them in as far as the value up program and everything else that's going on. It has obviously a very big AI component now in Japan. So we're up 3%. The topics is up by 2. Maybe just to close the loop on the commentary coming through from our guests earlier on, Monica Hsiao, who talked us through, is the canary in the coal mine. Watch the JGB market if and when we get to a point where it's real positive, real yields are back positive. That might be an indication of flow. Something to watch. We're quite some ways away, but just to say that's something to watch. Okay, Japan is going into the break, lifting the overall benchmark 1.3%. Everything but utilities, as you can see on the screen. IT is a big component, of course, following this rebound we're getting, and we'll get to the credit markets in a moment, just following that massive debt offering that we're seeing, not just from overnight, right? Just so far this year, massive amount of money has been raised in the IG space, in the debt markets, and IT here is up 2% in the equity markets, and it goes into where we are as far as the big AI plays in the region, plus, of course, NASDAQ futures.
Yeah, well, this has really been the big story in the session on Wall Street was this massive amount of debt issuance that we got from Alphabet. So $20 billion that was issued. That was way ahead of expectations by the tune of $15 billion and huge amount of investor demand as well. So just really interesting. We were been reflecting on over the show today, but we had those concerns around capex spending showing up in the results, and definitely we're seeing tech that's really being the big beneficiary, I guess, out of that amount of investor appetite. TSMC, of course, is one to track there because you've got those monthly sales figures coming out later today, but huge GDP upgrade as well that we got earlier.
Out of B of A.
Yeah, 8% now seen for 2026. That's a revision from 4.5, and I think it just talks to the overall health and demand that the semiconductor ecosystem is seeing. But let's get more on this and bring in Edward Chan. He's portfolio manager and senior investment analyst at Mirae Asset Global Investments. He manages global XAI and technology active ETF. And the top holdings, rather, I should say, in that are Alphabet, Apple, TSMC, Nvidia, and Meta. So you've got a really nice cross-section there of those two big stories that we're tracking. But let's just start off, I think, on this big Alphabet move overnight, because it is a huge amount of issuance. It's a really key theme for this year is just the amount of capex spending we see. How are you looking at that, and what do you think that means for the performance of your portfolio as well?
Yeah, so I think a few things to unpack here, right? So first is the CSP's capex have revised up quite significantly, right? And now they're coming up to their operating cash flow. Essentially, if you add up what the top CSPs are spending on capex, and then also some of the commitment for buybacks, and even some of them do dividends. If you add those all up, the number is coming up to their operating cash flow, and for Alphabet's case, I think it will exceed, because if you look at this year's probably around $200 billion of operating cash flow. They already say at the higher end, $185 billion of capex, right? Plus they do about 50-60 billions of buyback plus the dividend. So then you can see that numbers exceeding their operating cash flow, right? So I think that's the case for a lot of CSP. Therefore, they will have to raise some money or tap into their cash, right? So I think that's a reasonable step for them to do. Not to mention that if you look at the bond market, the spread is so tight, and so it's very beneficiary for them to raise bond now. And if you look at that particular issuance, right, actually, because as you mentioned, the demand is so high that their spread actually tightens throughout the pricing process. So I think that's what we're seeing now in the market.
Is that a good thing, that the amount of money is reaching what they take in from operations? The reason I frame it that way was because last year a big capex number was a good thing. Somewhat last few weeks a big capex number is not exactly a good thing to some investors.
Yeah, so I think investors are looking at this very dynamically, right? If you look at last year, Oracle, I think, is a good example, right? When they guide these very gigantic number, then the market actually penalized the stock because people don't think that they are able to fund it, and it's not really sustainable for Oracle, right? So I think coming into this year, some of the top CSPs like Google, like Amazon, if they're raising their numbers to this kind of level, I think investors will have to see their revenue, especially from cloud and AI, accelerating to justify for that capex, right? Because now we're not really looking at an internet company anymore. You're more like a utility company. If you look at the sheer scale of capex, Alphabet would be more than 3 times what TSMC was spent on capex this year, right? So that kind of number, and TSMC is one of the biggest manufacturing company in the world, right? So that gives you a sense of the scale that they're spending today, and I think that has to be justified by accelerating revenue growth.
We can get to TSMC in a moment. I do just want to finish off, though, I guess, on the overall narrative that we see around big tech as well, because we've been through a couple of different, I guess, chapters, you could say. And do you think we're closing at all the chapter on bubble fears and circular deals? Because if you think about the last couple of weeks, it's been a lot more focus on the disruptive capabilities of AI technology, and you saw that in the software stocks. You're seeing that in some of the car insurance stocks in Australia, but mainly US overnight. Do you think it's shifting at all?
Yeah, I think the pace of development in AI space is so quick, right, that even if you look at just the past 2 weeks, we see so many new things launching, right, whether it's some of the products Anthropic launched that caused this whole shockwave across software, or if you look at things like the Clawbot that people are using in the open source world, what people were able to do with that, and then plus, some of the Chinese models that are being launched, like some of the video generation models, are also really amazing to see. So I think it's the pace of innovation is so quick here that you could see that once some of these applications click, right, the room is huge. Especially if you're able to be productive with these API, then there's really a lot of room there to imagine, how big could these token consumption go? And you have to remember all the CSPs are capacity constrained now. They're only able to grow as fast as they could build their compute.
Right. Does that inform you in any way around? So I think interesting that Bell brought up the concept of, can we close the door on some of the recent concerns, and you could tie that to, this. I wouldn't say a narrative. It's more a projection of the rotation broadening out beyond the Mag 7. As someone who looks at an active portfolio, what is your thesis and how do you manage that if you believe the thesis continues?
Yeah, I think it's interesting to observe how the industry is progressing, right? Remember, if you look at the beginning of last year, right, everybody's also talking about the same thing, right? If you're spending so much on infrastructure, then should the broadening of rally go into the software space? And that hasn't been the case so far, right? Because I think a lot of these AI applications are in companies that are first probably not listed, and also in a lot of open source projects. And that's kind of scattered around. And even the concept of a company, I think, also changes, right? What if it's a developer in his bedroom that come up with an amazing application where millions of people use, and they're able to come up with, innovative ways to generate revenue that might not be the traditional form of company that we know of that are listed or that are raising money in the sense that we're very accustomed to, right? So I think a lot of that development is happening, and there are a lot of individual developers that are making a lot of money from these applications, right? So I think we can't just look at just the listed company and say, okay, maybe the application is not really picking up. I think it is picking up, but it's just in a very different way than we have observed in the past few cycles.
Let's just shift now to TSMC, because we've got those sales figures coming out. Of course, they're just one indicator, and we're at the beginning of the quarter as well for the business. But we can probably expect it to see strong sales, just given what we've already trended into the new year on. But do you see at all the upside for TSMC being constrained, just like we saw at the end of last year, that you just can't hold too much of it in your portfolio as well?
Yeah, so for me, of course, I'm already quite overweight on TSMC, and then I think I'm not worried about their earnings or revenue growth rate at all, right? Because I think at the moment everyone is fighting for capacity. If I look at the semiconductor supply chain, right, it's really just again capacity constrained. Customers are asking for a lot more capacity than suppliers could produce, whether it's on memory side or on the logic side, TSMC. So they're really just constrained by how much they could build and how high a utilization they could get to, right? And I think from the past cycles, of course, for the manufacturing companies, they're always concerned that in the upcycle we don't want to overbuild, because once that demand fades, then we end up with oversupply. So I think all the suppliers are quite cautious this time, given that the memory from the COVID upcycle is still fresh from that last semi upcycle, right? So I think that's a healthier setup as we move forward, as long as some of the bigger suppliers like TSMC, like the memory guys, don't really go too aggressively on these.
How are you looking at that, the emergence of memory?
Yeah, I think memory was a bit of a shock, to be honest, I think for the whole industry, right? I think nobody really expected memory demand to be this high. I mean, coming to this year, I think in the first half of last year, many people were worried about even a down cycle for memory. So I think that AI CapEx really, it's continued to be a surprise on the upside. I think not many people would have bet AI CapEx will accelerate coming into this year, right? Versus already been such a strong year in the past 2 years. So I think that continues to tie with the cycle of the overall AI spending. And you can see that memory for servers is squeezing the traditional consumer sector, traditional PC sector. And I think an interesting thing to see here is that AI is actually bringing inflation to the world even before it increase your productivity and ease that inflation pressure, because they're fighting for so much resource and power in semiconductor capacity that the prices of other things are raising.
Being driven up.
Yeah, are being driven up, right.
You also watch the China robotics space closely. So what are you seeing there in terms of the rollout of technologies and the adoption as well? Because we've had a lot of calls around consolidation, for instance, maybe being necessary already in the China humanoid space.
Yeah, I think it's such an early stage in the humanoid space, right? I think that it's just wide open for everyone to fight for a share in that space. And I think what China could really bring is the manufacturing capability, right, in the humanoid space, where if you look at the vision for humanoid to be shipping in the millions of units globally, you have to bring the cost down, right? If a robot costs 3-4 cars, then you're not going to be able to afford it. A regular family would not afford it, right? So you really need, I think, China's supply chain capability to support that humanoid rollout. If humanoid robot is really, the vision is really going to come true and the volume is going to hit that high number.
Edward, fantastic. Very nice to see you.
Yeah, nice to see you too.
Edward Chan, their portfolio manager, senior investment analyst, of course, one of the, I think that's the passive strategy we just saw on your screens there, the China robotics one. There's also the active one, which is the global AI ETF, listed here in Hong Kong. There's the plug. All right, out of Mirae there. Okay, coming up here, we look at the darker side of AI. Yeah, we didn't really get into that the last few minutes. How it's being used by scam centers to target more victims more quickly, resisting efforts to shut them down. This is Bloomberg.
Here are some of the major political stories that we're following this morning. And the Bank of France Governor Francois Villeroy has announced he will step down in June. That's well before his term was due to expire in October 2027. Villeroy says the decision is personal and it clears the way for President Emmanuel Macron to appoint his successor rather than leaving the choice to a future administration. The US is warning American-flagged ships to stay as far as possible from Iranian waters when navigating the Strait of Hormuz. In a maritime advisory, the US says Iranian forces have attempted to force commercial vessels into their territorial waters as recently as February 3rd. The warning comes after diplomatic talks in Oman, which were described by both sides as being positive.
Right. Let's talk about AI and perhaps the darker side of this. And you know how they talk about technology falling into bad actors' hands. You have senior Interpol officials saying criminals in Southeast Asia are actually harnessing cheap AI tools to target larger pools of potential victims at high speed, keeping these scam centers humming, even as governments have been cracking down or trying to crack down on this space. Let's bring in our chief Asia correspondent, Rosalind Matheson. Wrote the piece for us. Fantastic piece, Roz. Thank you so much for joining us. But yeah, talk to us about the specific technologies that they're using for them to be able to evade the long arm of the law not being long enough here.
Well, that's right. So they're actually using pretty cheap AI tools that are available to a lot of people, ChatGPT, large language models. And what that's doing is changing, in a way, the whole nature of the scam business and will only accelerate over time. And that's everything from the ads that are used to lure people to go to Southeast Asia for jobs. A couple of years ago, those ads were pretty poorly done. They had lots of red flags you could spot. Now, Interpol and others are saying those ads are getting increasingly sophisticated. And then there's the scams themselves, that you can run scams with fewer people. They, again, are much more sophisticated. You can use AI, for example, if you're a male, to mimic being a female. You can even do that in video format if you're trying to converse with someone online as if you were a woman, for example, to try and lure a man into investing in cryptocurrency. So there's lots of ways it's showing up now in the scam business. And what they're saying is it's making scams, if anything, even more cost effective and low cost to do, because it's a bit of an anecdotal figure that gets bounced around. But basically, one person in a scam center using AI effectively is about the same as 10 to 20 other physical bodies in a scam center. So they can run these scams at much higher scale, at much lower cost as a result.
So more proliferation and greater sophistication. There are clearly, obviously, challenges for people that are trying to catch these fraudsters. But is there a way as well for enforcement agencies to try and use these tools?
Well, that's right. They're saying the flip side, of course, they can use AI to try and track scammers in real time faster. And also they note that because of the use of cryptocurrency, they're really trying to focus on efforts to trace cryptocurrency a lot faster. But that all depends on coordination. And there's a lot of countries involved in this, a lot of agencies involved in this. You have people who are looking at different aspects of this: cyber, human trafficking, money. Are they all coordinating in the way that they should? You have tensions right now between Cambodia and Thailand over their border. Agencies and countries say it's difficult to coordinate with Myanmar and Cambodia directly on this. In order to really use AI properly across borders to track scams, they do need lots of countries to cooperate. And that's one ongoing challenge that Interpol also talks about.
Ros, really fascinating piece and definitely worth reading as well. That was our Bloomberg Chief Asia Correspondent, Ros Matheson there. And a reminder of our new online feature, that's the Bloomberg Video Hub. Subscribers can explore live streaming, news and interviews, all of our Bloomberg TV shows, documentaries, reporter analysis and more. So do check it out at bloomberg.com/videos. This is Bloomberg. Well, the IMF Managing Director Kristalina Georgieva has downplayed the dollar's decline over the past year. Speaking to Bloomberg at an emerging market conference in Saudi Arabia, Georgieva said the US currency should retain its preeminent position.
we should not get carried away by short-term variations of the exchange rate of the dollar, and we should look closely as to why the dollar plays such an important role in the international monetary system. First, over time, we have seen the dollar going up and down, and actually the dollar being somewhat down now is good for many emerging markets. Those that borrow in dollars now have to pay a bit less. But also what we know is that the reason the dollar plays such an important role is the depth and liquidity of capital markets in the United States, the size of the economy, the entrepreneurial spirit of the U.S. So I don't see a change in the role of the dollar in any time soon.
Okay. So you don't see that changing anytime soon. The other, I was just watching the panel now with His Excellency Mr. Jadran, and he mentioned that markets can be brutal, particularly when it comes to economy spending plans and fiscal and rebuilding fiscal buffers is another big narrative that has emerged out of this conference. Do you think that countries are taking this seriously enough, especially when, again, investors are tending to punish countries that seem to be overborrowing right now?
Well, countries better take it seriously. What has happened over the last couple of years is COVID, the war in Ukraine, they all led to government spending more to support businesses and households, rightly so, at that time. But what is the result? Fiscal buffers almost everywhere are depleted, and shocks are still to come. Therefore, what we say to everybody, to advanced economies, to emerging markets and developing economies, is now is somewhat better time. We have seen the world economy quite resilient to these shocks. Please concentrate on rebuilding these buffers. You need to have a medium-term prospect for how your fiscal position can be strengthened to withstand the shocks that inevitably will come. How are governments doing? Some better than others. And I can tell you where I'm particularly concerned is for vulnerable middle-income, low-income countries that are particularly stretched today. So what we want is not only for them to do the right thing, but also for the world to be mindful of these countries. We have seen development assistance going down. Well, we have a responsibility for stability and security in the world. Help these countries.
There you go. IMF Managing Director with, of course, our colleague there, Jomana, in Saudi Arabia. Okay, let's very quickly go through these markets. Some big moves as we close out the show here. Massive move, first day of trade. Are we looking at this?
I think we've moved to
have we moved on?
Markets. Yeah. Oh, no.
Oh.
There we go.
Just a reminder of how big first day at school can be. Not in many cases traumatizing if you look at it that way. 560% onshore markets debuting today. We gave you a little bit of a tease of the rally earlier on. Nikkei on the break. Massive move going into the lunch break there. Kospi, the TAIEX index. You have two things. TSMC is out with monthly sales plus this massive upgrade coming through out of B of A from 4.5% to 8% GDP growth in 2026. Things are going well. Hang Seng Index coming up on your screens, how we've done since the open, about going on 19 minutes now on the Hang Seng Index. And off highs of today, 0.7 of 1%. But the currency continuing to strengthen here. 2023 highs on the yuan. Dollar weaker. That's it from us. We'll see you all tomorrow.